Hello, everyone. Thank you for joining us on another episode here with K Properties and Investments. My name is Matt McFarland. I'm one of the senior vice presidents here at the firm. Today, we're going to be digging into a popular investment strategy topic we've titled the Anchor and Buoy Strategy. I'm really excited to be joined with our very own Tim Emanuel, vice president here at K Properties.
Thanks for having me.
Tim, thanks for being here.
Yeah, absolutely. It's nice to be here with you guys.
Yeah, excited to dig into this. A lot of our investors are coming to us, looking for solutions for their 1031 exchange. And the DST structure, which is the structure that our firm specializes in, specifically is attractive to investors who are looking to invest passively, but also diversify and hedge some of their downside. And the Anchor and Buoy strategy, we're going to get into it in just a couple of minutes, but it's a really great strategy that we use to pair different asset classes together in a comprehensive portfolio. But before we jump into that, thought it'd be helpful maybe to give just a quick overview of the DST structure, maybe for someone who's listening for the first time. So the DST structure is a passive alternative for investors to consider when completing a 1031 exchange. So these are prepackaged, structured investments that are made available to high net worth accredited investors, really those that are looking to shed all of the day-to-day management responsibilities. And here they're able to take their 1031 exchange proceeds, identify specific DST investments, and invest specific dollar amounts into those DST investments.
That's right.
So I think that's really the driving factor behind the ability to defer taxes via the 1031 exchange, is the ability also to move from a very typically active management position or role to a completely passive investment experience. And so our role as representatives when we're working with investors is to educate them on the structure, make sure it's a suitable approach for them.
Good fit, yep.
And furthermore, be able to drill down and provide specific solutions that could fit an investor's specific portfolio and accomplish what they're trying to accomplish. So to kind of drill down specifically on the topic, Tim, maybe you can just briefly describe the Anchor and Buoy strategy, what we mean by that, and how we incorporate that when we're talking about diversification.
Yeah, no, absolutely. It's a great topic to cover with new investors and those that have been around for a while too, because there's a lot of opportunities in the DST structure and space. Because we have so much exposure to different parts of the country that are growing, different asset classes, different business plans. And so instead of just being, having all your 1031 proceeds into, one investment, why not have them diversified in such a way that, you can provide a little bit of a hedge for yourself, a little bit of hedge for your, of wealth protection there. And it's a great tool to be able to do that. So we've divided these over the years into the Anchor and Buoy, and we have a little bit of a nautical theme here, I think, as K Properties. Just being a West Coast company and, being so close to the ocean, it makes sense for a lot of folks to be able to relate how, one investment, a sure and steady, very stable investment could be referred to as an anchor. And then another investment that's perhaps got some growth potential as far as the NOI actually goes, could be referred to as a buoy, okay? And so they both fit within the overall investment portfolio, just they serve a couple different purposes. With the anchor style investment, we're going to be looking at a lot of net leases. Think about a type of asset that's got very predictable income. And so that's going to be, your long-term tenant, maybe on a 10 or 15-year lease that's got, pretty very well known step increases with the lease payments and whatnot. And this is going to be your typical, FedEx or Frito-Lay or some type of asset where you've got a nice predictable income stream over the long term that's going to be that, hopefully that real steady performer in the portfolio. And so, we call that an anchor asset, and it's designed to really keep things planted, keep that predictable income coming in.
Yeah, and I really like going back to the nautical theme. The anchor sits on the bottom of the ocean floor, or the lake floor, river, whatever. And the intention is, as you described, Tim, is to create consistency.
Exactly.
And that consistency specifically applies to predictability as it relates to the income.
That's
so
right.
Investors who are looking for that predictable, durable, monthly income stream would naturally gravitate more towards maybe more of an anchoring asset class.
Exactly.
Like could be, like you said, net lease, whether it's medical, industrial, even retail in certain cases. With the anchor on kind of the other side, typically these assets maybe don't have as much appreciation potential.
Sure.
As say other more operating asset classes, which we would describe as the buoy properties, which we'll get into in just a minute. So there's always a give and take, right? There's always a push and pull. And so the benefit of the anchor is the potential, surety and predictability in the income. The give is that there's typically less upside potential down the line.
That's right. Yep.
And these particular assets, like I said before, are more attractive to certain investors than others.
Right.
But if we take a step back and look at it from a portfolio perspective, are still very important to at least consider in the context of an investor's portfolio.
Exactly.
So before we maybe talk about it, with both strategies combined into one, can you describe what we mean by a buoying property
Absolutely.
and how that comes into play with respect to DSTs that are available?
Yeah, no, that's the other piece of the puzzle here. When we're putting these portfolios together, we really want to focus on making sure that if an investor wants some type of growth or some way to really keep up with inflation even and to be able to keep up with rising rents, that they have access, and they can do that with multi-tenant, multi-family style properties. And those are what we would typically describe as being buoy assets. And the reason why is that if you think about how inflation tends to rise rents, a buoy would float on top of the water, and we would like this asset to do the same thing, to be able to drive NOI as they increase rents. Now that comes with a trade-off too. Because typically, with multifamily or multi-tenant, if you're familiar with those asset classes, you can, a lot of times you buy them in the right markets, very, very strong lease up ability there. But, you might have shorter term leases. And so you might have 2 and 3 and 5 year leases versus your long-term assets, like your large corporate backed ones that are going to be significantly longer. So if you're in, let's say, a multifamily style investment, those are going to be 1-year leases, right? You're going to have turnover potentially every single year as your tenants go in and out. So there's a degree of potential volatility that comes along. And again, we can mitigate that by being in the right market, the right asset class. And also with, the right asset is inherently important too. But what we have found is that when we combine those anchor assets with the buoy assets, we now have a portfolio that's well-grounded, that's anchored on one side, but also has the ability, the rents on part of the portfolio have the ability to continue to grow. And that provides really, a nice total return for a lot of our investors when you are able to plan that in advance. And again, most of our investors are coming from one single asset as part of their 1031. And so now we're giving them the opportunity to diversify, taking a look at different strategies and trying to drive the overall portfolio in a more stable way.
Yeah, that was really well said. And to return to this concept of the buoying asset types, these are, as you said, asset classes that have shorter lease terms, generally speaking, and a more substantial degree of landlord responsibility.
That's right. Yeah.
Versus tenant responsibility. So we kind of, to peel that apart even further, something like multifamily, generally you have annual leases followed by month to month, following that first year. So there's a much more frequent turnover in your rent roll, which can be both good and bad, depending on the environment that you're operating in. It could be really positive if you have the ability to reset the market in a
Right.
rising rental rate segment of the cycle.
That's right.
It could also be bad if the opposite is true.
That's right.
As
That's a great
new
point.
competition comes online, or if the economy is suffering and people can't afford more, it swings both ways, and that translates right to the net operating income, your bottom line.
Yep.
And is why we describe an asset like multifamily as a buoy, right? We think of a buoy sitting on the top of, the ocean, or, the river, whatever body of water you want to use in this analogy. And the buoy adjusts, right, to the tides,
Exactly.
it adjusts to the swell, whatever is on the surface of the water, that changes based on all of the factors that are going on outside.
That's right.
And so these buoying assets are more sensitive to movements in the economy. They're more sensitive to movements in that submarket specifically,
Yep.
in what's happening in immediate proximity to the property. And once again, this could be positive in certain segments of the cycle. It can be negative in others.
Exactly.
But I think the overall theme that we're trying to get at is these asset classes, specifically like multifamily, if you give yourself enough holding, term or flexibility, generally speaking, there's an upward trend, both as it relates to the net operating income or the rents, but also the value as you're able to hopefully push those rents, over an extended period of time. So you have, one extreme as, call it the month-to-month,
Sure.
Leases in multifamily as renters get through that initial annual lease term that they sign. All the way on the other end, you have an Amazon distribution facility that's triple net, meaning the tenant's responsible for all taxes, maintenance, and insurance, guaranteed by Amazon.com, right? Which is on the complete other end of the spectrum. So I think to kind of bring it together, which you were starting to, I think the interplay between all of these different asset classes in the context of a singular portfolio is where a lot of the value comes in, specifically for DST investors, because it's not a binary. Investors don't have to put all their money into the multifamily.
Exactly.
They don't have to go all into Amazon. They can take a position in each. And if you take a blended average of the whole, the anchoring assets, could potentially provide you that stability in a down market, whereas the buoying assets can give you that lift in an upward trending market, and all the while limiting your ownership interest into any one specific investment, any one singular business plan. And really where we feel like one of the most significant advantages come in the context of investing in this way, right? Is having the ability to do that.
And it's a conversation to have with your advisor too when you're talking about these, because one of the things I want to ask, I know you want to find out too, is what does this investment mean relative to their financial objectives, their net worth, their overall portfolio diversification? Because a lot of our investors, obviously, this is not their only investment. They have many properties. They have, generally a handful. And if they're already invested in one type of asset class or oriented in one area, the DST opens the door to be able to find more. And conversely, maybe they already have a good number of anchor assets. They've got plenty of steady income. This is a conversation that I'm going to want to have, with the client on the phone, saying, hey, what is your goal for the money? What is your goal for what this investment is going to do? And then what asset class, which available DSTs do we have that are going to best get you there? And it's important. Every answer is a little different, right? I think your classic anchor-oriented type of investor is probably going to be saying, I'm into retirement. I've built what I want to build. I now need predictable income. I want to protect. That's what I'm all about. I'm about protection. And then we have other investors where, they're using the DST for, part of their overall growth plan of their portfolio. They want to protect what they have. Sure, that's why we're here doing the 1031 in the first place. But they're not ready just for steady income. Maybe they're still working. And what they really want to see is opportunity. And so we are able to then customize each one of those portfolios and really kind of get a piece or get, a certain percentage rather, oriented in the direction that best fits their goals.
Yeah, I think that was really well said. And once again, one of the major advantages of the flexibility of allocating specific dollar amounts to specific DST holdings is that every investor's portfolio can look different.
Exactly.
From the rest, right? You're working with, a 55-year-old working individual. Their portfolio is probably going to look very different than the 78-year-old, retiree who is more sensitive to the income and the predictability of it over a longer period of time, and maybe less concerned with the long-term upside potential.
Right.
And then there's everywhere in between. Like, I love what you brought up of taking a global view of, okay, how does this fit into the total real estate that you own, right?
Exactly.
Are you over concentrated maybe into residential? Okay, let's use this exchange as a way to diversify out of that and incorporate some other asset classes that maybe that investor doesn't have any direct experience operating on their own, but they can rely on the expertise of these very prominent sponsor companies who this is what they do all day, every day. They're in the market operating these asset classes and are able to leverage the benefit of their expertise, through this structure. And going back to what I was saying is it's not, it's not a binary, right? If someone is in an exchange for, say $1 million and they're spreading that across 5 different DSTs, maybe that investor is looking to do 3 out of 5 positions into more of a buoying asset, and maybe 2 positions are, into more of an anchor asset. So they're 60-40, or they could do, 80-20. I mean, there's a million different ways to kind of slice the onion here, so to speak.
And then change over time, right? Because, I mean, your objectives now are one thing, but, if I'm, 5, 6, 7 years from now, if that client's now retired, and we have a turnover as these things go full cycle, it's another opportunity to rebalance. Yeah,
absolutely. Yeah. And that's, with these DSTs, the holding periods are typically 5 to 10 years. 5 to 10 years, a lot can change in someone's life, and the ability to have another opportunity to kind of reevaluate and reposition can prove extremely valuable as well. So a really good point.
Yeah, absolutely.
Well, I think we'll probably wrap it up there, Tim, unless you have any last words or anything, any calls to action as we close here.
No, I mean, those are the major takeaways here are, diversification is your friend as long as you have the right options. And I think the Anchor and Buoy, it really is a simple way for folks to think about how they can position on their own. And then as they look at our inventory, I just recently, when I logged on, I noticed there's well over 70 different offerings that are available that we've looked at, that we've gone through, some Anchor, some Buoy. And as you look at it and start working through it on your own to try to say, hey, what are my objectives? What's going to help get me there? And then rely on us, because our due diligence, we look at these every day. We look at them all day. We understand the sponsor company's goals too. We understand their track records and their history, and lean on us, because we're very much able to shed light on what we see as being potential factors on the individual successability of that DST and how that portfolio can really work for each investor to its max. We're happy to help out. Reach out to your advisor. We want to be here to help you as you put these offerings together into a portfolio that works.
Yeah, absolutely. I couldn't agree more. If you haven't reached out to us, please do. Talk to your advisor. Go over your situation. We can construct, sample proposals and start to piece all this together for investors. And then In closing, too, definitely want to direct all of our listeners to our website, kpi1031.com. You can access all the current offerings there. Also, we have a whole database, a whole library of educational resources that are extremely valuable. Please visit our blog. There's other recordings of webinars, of presentations, conversations like this. So please visit our website, kpi1031.com. Hopefully you found this conversation helpful today. Tim, really appreciate your time as always.
Yep. Thanks for having me on, Matt.
Yeah,
Appreciate it.
Absolutely. Everyone have a great rest of your day, and we look forward to talking to each and every one of you very soon. Take care.
Visit us at www.1031.com for instant free access to exclusive investor resources, including our DST 1031 Exchange Book and the first ever 721 Up REIT book, written by our CEO and founder, Dwight K. You'll also find our Delaware Statutory Trust catalog and investor case studies. The K Properties team has helped over 4,000 investors nationwide, and we're here to help guide you every step of the way. If you'd like to connect with us directly, give us a call at 855-899-4597.